Good evening, everyone, and welcome to today's webinar on trading the essentials, understanding trading in commodities. And today we are going to discuss about uh, commodity market, what commodity market is, what are commodities. We are also going to go through um, the movement in a few commodities and see how they have moved, how to buy and sell these commodities using the live platform. My name is Yogesh, and this session is powered by Century Financial. We are an investment consultancy. We have been in UAE for 35 years. We have an office in Dubai. Have a branch in Abu Dhabi. And the purpose of conducting these sessions is to keep our investors, keep our clients aware of what's going on in the financial markets, make them uh, more independent in taking their investment decisions, and at the same time, bring you any new opportunities, any new ideas which could come across. As we all know, that financial markets are very unpredictable, um, and in spite of research and technicals and fundamentals and lot of information which is available um, today, there are always some elements which could produce uncertainty, which could bring that unpredictable nature of the financial markets in front of us. And that is why we talk about diversification, we talk about risk management. In During the beginning of this month, I promised you to bring a webinar every single night, Monday to Friday, and we have done that. We started from financial literacy. We talked about investor psychology and behavioral finance. We talked about fundamental analysis, technical analysis. We talked about options based trading. We have talked about investments in sustainability, investments in mega trends, or investments in disruptions. We have talked about um, investment in bonds. We had a session yesterday on the impact of US elections on your portfolio, and we have discussed advanced technical analysis and technical studies and how they work. We also went through value investing portfolios, where I brought your attention to some companies which have been shown undervalued and have a great potential to grow. And while doing all these sessions, I've received a lot of comments, a lot of feedback from a lot of you who have attended these sessions, and um, thank you so much for the overwhelming response. A lot of you have done one-on-one sessions with me after these webinars, and I really appreciate you coming on and asking and showing your interest in learning this. Today, we are going to learn more about the commodities based trading, what commodities are. I'm going to uh, use the live platform also today to show you that how, on an average, a commodity could move. So that would give you an idea that if I'm buying or selling a commodity, what I'm getting into. I mean, that's something which is really important. So we believe in giving you the information which will be really helpful to you in the market. So while we continue to understand what commodities are, I'll also give you some practical experience and see how the prices of the commodities move. So thank you so much. Your chat options are on, and to test it, if you can hear my voice clearly, if you can see my presentation, um, do send me a thumbs up or a yes or okay, so I would know that you can see me properly and you can hear me what I have to say. If you have any questions in your mind, like always, please ask. Use your Q&A options to send me chats and ask anything which you have in mind, and we'll get into a detailed discussion of what it is like to trade in commodities. Now, starting from today, we'll also go through a live platform, as I said. But whatever trades we are going to execute today, it's only going to be for demonstration purposes. It's going to be for your understanding. Um, Please refrain from placing the trades which I am trading in my demo account. Please try not to put those trades in your live account without a proper consultation. The trades which I'm going to put today is only going to be for your demonstration information. If you want to do any live trades, I would always suggest that please talk to your risk consultants, talk to your investment consultants, understand the risk behind it, and only then pursue this area of learning. Starting with derivatives and commodity markets. So, it's important for us to understand what derivatives are in order to be trading in commodities. So, derivative is a financial instrument whose price is derived from the underlying asset, and the other asset is generally referred to the underlying asset or sometimes just the underlying. The idea of a derivative is that this market is huge, right? And when we talk about derivatives, we must understand that while the buying and selling involves physical exchange of products, um, these orders, these buyers and sellers, they can do this trading through the use of derivatives also. And we are going to give you an example of how derivatives would work. And just to give you a easier example for understanding, gold as a metal, it is an underlying asset. As we know, it's a yellow shiny metal which exists, right? And we know that gold as, or oil for example, as a crude oil barrel in its physical form as an asset, it exists. But similarly, if I were to talk about derivatives in that particular commodity, these derivatives would be financial instruments whose value is derived from that particular asset. So, what is the purpose? You are an investor, and these derivatives will allow you, the investor, to participate in the commodity market, but without taking physical possession of the commodity itself. This is what you have to understand. Forget about the terminologies, forget about how definitions, how many definitions you have heard about derivatives. In a commodity market, when we talk about a commodity derivative allows you as an investor to take a trade or to buy or sell the commodities or speculate on the prices or participate in the commodity market without taking a physical possession of the commodity itself. So, using the commodity derivatives, you can, or using the gold derivative, you can buy gold and then you can sell it if the price goes up. But in that entire transaction, you will not have any physical delivery of any sorts. So if you buy a gold derivative at the current market price and the price goes up, you can sell it and you can receive the profit. And that profit and that entire transaction will occur without you needing any physical exchange of gold. That is what a derivative is in commodity markets. Similarly, when there are derivatives in stocks also, and when we talk about derivatives in stock, um, like for example, if you're interested in investing in Apple stocks, but you're really unsure what's the future price is going to be, now you could buy shares directly, but then again it requires a significant investment. So when you try to buy a derivative of Apple stock, it does not require the same amount of investment. Instead, these derivatives allow you to take a trade by just putting a small token money, and you can trade in the entire Apple shares. If the share goes up, you're in profit. If it goes down, you're in a loss. But either way, you don't have to use your full money to buy that share. You just have to pay a small token money, which is called margin money, and you can speculate on the prices going up or down. Derivatives can also be used to protect your portfolio, because when you're using a derivative, it allows you for short selling also. It allows you to do short selling also. We'll go through uh, a platform to show you how short selling works, how derivative trading works, how margin trading works, and you will understand that why derivatives market is, it's one of the bigger markets. Now, understanding about commodities, what commodities are. This because this session is more about understanding trading in commodities. We are going to dig a little deeper to understand that how commodities move. Commodity is a basic good used in commerce that is interchangeable with other goods of the same type, most often used as inputs in the production of other goods. So a lot of times we know that we are talking about commodities when it comes to commodities which are based in energy. So I'm talking about energy based commodities, which is crude oil, natural gas, heating oil. Then there are commodities which are based out of grains, which is agricultural commodities. And I'm talking about corn, soybean, wheat, rice, sugar. And then there are metal based commodities like gold, silver, platinum, palladium, copper. And as I said, there are agricultural commodities like sugar, coffee, which are there. Commodities can also be in the form of pork, live cattle, and these are available for trading, but then it's up to you what sort of commodities you're interested in. There's a question over here that is interest rate a part of derivatives? Yes, depends on what sort of derivative you are invested in. If you're invested in a gold derivative, if you have purchased gold, or if you have purchased a derivative of a stock index, then yes, interest rates, when they move up or down, it definitely impacts your trade because, uh, right, let's take an example of what happened 3 days ago or a week ago on 18th of September. Central Bank of US, which is Federal Reserve, announced a 0.5% cut in the interest rates, and that pushed gold prices higher. So if you were holding a gold commodity derivative, the interest rates would participate in this. If your question is that can you speculate on interest rates using derivatives, I mean, you cannot do that, but there is something called swap, which allows you to trade in currencies. But interest rate is a part of a derivative indirectly, because if you have placed trades in commodities and currencies or indices using derivatives, interest rate decisions are definitely going to impact that. Plus, a lot of times it happens, uh, commodities, especially gold or crude oil, they have something called um, a holding cost, which is the cost of carry. So a lot of times in when investors in US, when they enter into a future contract, which we are going to discuss later, um, they buy that contract and expect a physical delivery, uh, because there are two ways you can have a physical delivery, and most likely the investors who trade in derivatives, they don't do it for the physical delivery. But if you are a manufacturer or a producer or a consumer and you are seeking physical delivery, you can create a derivatives contract which will allow you to accept the delivery also. So during that time, we have seen that the cost of carry or the holding cost, it creates a significant role. But then here, when we are talking, we need to be only concerned about uh, how the commodities work and interest rates. As we talk about, interest rates are only going to play an important role when we see uh, the trade which we have placed. So if we are buying gold or silver, a rate cut would push the prices higher, and that is specifically for metals. When it comes to corn, soybean, or wheat, interest rates do not really matter. What matters is the seasonality of these commodities. So that is also something I'm going to tell you a few ways that how you can trade into commodities using the seasonality pattern also, and that is also something which is going to be really really interesting. I'm going to explore some ways how you can trade. But thank you for the question, and please continue to ask if your doubts are clear or not. Please do ask me again and again, and I'll make sure that uh, we try to clear all your doubts before the session is over. So these are the kinds of commodities which are available now. There are some attributes of the commodity which you're trading, you're buying or selling. Like for example, when you're using or when you're buying gold, you're buying a 24 karat gold. Normally when you buy a commodity on an exchange based platform, there's a fixed quantity which you can buy, which is called a lot size. So, for example, if you buy a quantity of gold in a US exchange, minimum quantity must buy is 100 ounce of gold, and one troy ounce is 31.1 grams. So you have to buy at least 100 ounces. But on derivative platforms, like virtual platforms, you can buy as small as 1 ounce or 10 ounce, right? As far as location and time, as I said, that there are a lot of commodity buyers and which actually trade in commodities to get physical deliveries, and that happens only in US, not in UAE. And even in US, that there are selective people who wish to take the delivery of the product. But here in UAE, obviously, there are no brokers which provide a physical delivery. But just to give you an idea, that for a commodity trade to obtain a physical delivery, the location, that where the goods are to be delivered at, and the time when it will happen, these are some important attributes. Now, moving on to the idea trading instruments. Now, how do you trade in the commodity? So, there are spot contracts and there are forwards and futures and options. Today, we are going to discuss about spots and futures. Most likely, these are the important ones, and this is something what you see. For options, we have had a session on options trading, a few weeks ago, but we can always discuss options much more in detail. It's again a much vast concept. But today, we are going to understand the spot and the future part. Now, when you see the spot, talk about the spot trades, spot or cash in many virtual platforms, it means the same thing. Spot refers to the transaction for immediate delivery. So, delivery is on the spot. Now, I know in the beginning I said that derivatives allow you to engage or participate in the commodities market without taking the possession of the physical delivery, right? Or the physical exchange. As I said, you can choose to not have that physical delivery, or you can just settle the price difference in cash. So, for example, you purchased gold at 2650, it went to 2660. Now, if the price has gone up, you want to sell gold. When you purchased at 2650, you do not need the physical delivery when you are purchasing. And when you are selling it, you don't have to sell physical goods because you have not received any physical goods. You can do it completely a paper transaction or a virtual transaction, which will allow you to take that, which will allow you to take the exposure. But in major exchange markets, as I said in US, the term spot trades refers to a transaction for immediate delivery. So if you buy gold, you get immediate delivery. That is a delivery on the spot, and that involves a prompt exchange of goods for money. You pay the money, you get the goods, right? Spot trades almost always involve actual delivery. All spot trades are cash trades, which normally means that you give the cash and you buy the commodity and get the physical delivery. Again, guys, here in UAE, there is no physical delivery of any kind. So when you're using derivatives and buying or selling using these virtual platforms, but why I'm telling you is you should have the knowledge that this is not an alien concept, and physical deliveries do happen if people use exchange platforms out there. So that is the real difference, because a lot of times I've seen clients use a virtual trading platform where they read spot and futures, but they don't really know what spot and future is. So this is just for your information, that spot trades means that you buying something and you getting the physical delivery of that particular commodity promptly. At the same time, there is a forward market. So there's a spot market, there's a forward market. So forward market, or a forward contract, or a future contract which comes in. So future contracts are like forward contracts. So just let me give you an idea what a forward contract is. Forward contract is opposite to spot. Forward contract, when you buy actually from the exchange, it specifies that when the commodity is going to be delivered, when it will happen. So it will happen at a future date. It will be happen at a pre-agreed price. So today the buyer and the seller agree on the contract terms, quantity, quality, location, and when it will happen, when be the delivery date, right? There is no cash exchange, right? Because the contract will be settled after a certain period of time, and that time will be decided between the buyer and the seller. Contract is performed on the expiration date. So when that date comes across, that's the expiration date of the contract, and that's when the goods and the product exchanges, right? Now, forward contracts are not standardized, which means there is no specific quantity which needs to be decided. In case of future contracts, which is just like forward contracts, a specific quantity is decided between buyers and sellers. Now, there are two major differences over here, guys. Why I'm telling you about spot and forward? Because now, when I go to the actual platform where you can buy and sell these commodities, you will see two kinds of products. One will say cash, and that means in the exchange market that you pay and you get the physical commodity. But when you'll be using this in an online platform, you will not get the physical commodity, but the name will still say cash. So this is just so that you do not get confused while you are doing this. And some of the contracts which you will see on the online platform, it will have a month next to it. That means that that month has an expiry date, and when you place a trade using a future contract, you can hold on to this trade for only a specific period of time. So that is going to be the difference between a spot trade and a future trade. You can buy a spot trade, hold on to it as long as you want. You bought at $15, price went down to 20, you still want to hold on to it, you can. A future contract, you bought on 15, it's still on 20, you want to hold on to it, you can, until the contract reaches to the expiry. If the contract gets expired, your trade will be closed. Whatever your profit or loss is, it will be booked. But you will not get any physical delivery because you are doing this on an online platform. If you were on an exchange-based live platform, then you would be able to get physical deliveries also. But again, as I said, that is something which happens in US, and a lot of people who are actually willing to take the physical delivery, they participate in these trades. Others, they just speculate like you and me. Right, so as I said, future contract, the most important difference between a forward and a future contract is standardization. If you're buying a future contract from an exchange house, you need to buy a specific quantity, and that is the difference between future and forward. Now, as I said, there are two ways. Right now when I am talking to you, I'm showing you two different markets. One is the exchange based market, right? And then one is these virtual platforms which a lot of companies provide, which are also called CFD based platforms. Both of them provide you derivatives, but then in an exchange traded market, there is a standard quantity, there's a standard marketplace, right? There is a proper exchange which is regulating the trade. And when you buy, you can actually get a physical delivery of the product. But on a over the counter, on these virtual platforms which we talk about, there is no physical delivery. And these kind of over the counter platforms are mostly located in Europe and UK, and a lot of these now are in UAE also. So a lot of people, they buy and sell these products on the virtual market more, on the OTC platforms more. And I'll tell you the reason why. I'll take you now to the live platform, and then soon we'll come back on the screen and just try to learn a few things about the derivatives market and how they have performed. So let me take you to the live platform, and I'll help you create a watch list. If you're with me here, just write it down, the commodities which I'm showing it to you, and then you can track these commodities and then look at the prices. I'm going to give you a very detailed understanding of how much these products move on an average. So I'm going to share my screen and log in. Okay. Now we are entering into a live platform. Okay. This is where exactly, so this is going to be that virtual marketplace which will allow you to participate in the different kinds of commodities we just discussed. Let's make a favorite list of the commodities which um, I would request you to track day on day. And it does not mean that you have to be glued to your screens or app and just keep tracking it. Tell you a time zone which and when these commodities move a lot, and that will really help you to actually get through the understanding that at this time I should be looking at the prices, and you will be able to see the changes, that how much it has moved. Let's make a list. Okay, how do you make this list? Go on this, go on the watch list right here. So I'm just close everything and the blank screen. This is your products library and this is your watch list. I'm going to create a new watch list right here. I'm going to write commodities market, or let's say century commodities market 2024. So this is the name of my list, and now I'm going to add products. The commodities which I'm giving you are the ones which are traded a lot. So there are so many commodities. There is aluminum, lead, zinc, nickel, copper, uranium, and there are so many other common commodities, tea, coffee. But I am only going to make you add the commodities which are traded a lot and are available on a lot of platforms. So you can always find these products everywhere, and you can track these products. You can look at their prices, and I'm going to dig a little deeper that how these products have moved and how much it on an average it moves. And then let's try to execute a few trades together and understand that how it works. I'm going to add the first thing, gold versus US dollar is what you have to select right here. Gold versus US dollar. This is the actual commodity gold versus US dollar. Selected, comes as gold cash, right? I just explain you what it means. It means you buy gold and you get the physical delivery if you are on an exchange platform in US. But here, when you buy gold, you do not get any physical delivery. And but if you buy this, you can hold on to it as long as you want to, right? So here, let me add gold, and then I'm going to add silver. Silver versus US dollar. That's the silver commodity, direct commodity, which we're looking at. Silver versus US dollar. Then there is platinum, palladium, and copper, right? These are the metals which you must be: gold, silver, platinum, palladium, copper. These are the metals. I'm going to move to energy, crude oil. Add crude oil Brent, and then I'm going to add crude oil West Texas to tell you the difference between both. Then I will add natural gas. Move on to agricultural commodities. I want to add wheat. I want to add coffee Arabica. And let's add cotton. And not to forget sugar, raw sugar, right? There are more agricultural commodities, but let's stick with what we have and let's try to understand that how these are priced. So I'm going to create this watch list. This watch list is added. So I go back to my watch list and I click on Century Commodities Market 2024. And now, if you see, this list has been prepared. And this, as you can see, the markets are already open and you can see that these are already trading and they are already moving. Now let's try to understand how they work, and we are also going to understand that a basic difference between how these commodities are, like for example, difference between Brent and WTI crude oil, how the difference is, because most of the time we see that these two oils are the ones which are traded the most, right? And Brent being the benchmark. So if someone asks you what is the oil price, you directly look at the Brent oil price and then you tell them that this is what it is. Let's start from gold first, as it has been one of those commodities which have taken a lot of attention. Gold prices uh, currently are priced. So when you're looking at the watch list, you see the name of the products. And then you go to the extreme right, these are the buying and the selling prices, right? The ones are in the blue, they are buying prices. The ones in the orange are selling prices. Then there are four columns: the price at which it is opened, the highest of the day, the lowest of the day, and yesterday's closing. Now, whatever the price closed at yesterday, as compared to yesterday, and the current market price, this is the difference in cents and this is the difference in percentage. So these are the two columns which shows you the difference between yesterday's closing and the current market price. Please remember this and note this down somewhere if you can. When you are trading or in any product, the closing price has a lot of significance than the opening price. It does not matter where the market's opened at, but if it closed higher than the opening price, that candle is green. That's a good news. That means that it closed higher than the opening price, and that's what matters, because at the end of the day, that means that it ended on a positive note. On the other hand, it opened higher but closed lower. It is called a negative closing, right? Or a lower closing. That is not a good or a positive sign if you're on the buying side. So that is why when you see the points change and the percentage change, I hope this everybody can see this a little clearly. If not, please tell me. I'll try to zoom in a bit. So what I'm trying to tell you is that if you look at this, the two columns, the price change and the percentage change, that change is not the difference between higher or lower prices or opening or the closing prices. That difference is between the yesterday's closing versus the current market price. It gives you an idea that as compared to yesterday, what's the current trend like. So the ones which you see in red are negative, the ones which you see in green are positive as compared to yesterday's closing. Let's start with gold. I click on gold. I see order ticket. Shows the price 2657. Please understand this. 2657 or 2600. Look at the movement which is happening right now. $2,657. Gold is priced in dollars per ounce. 1 ounce or troy ounce as we call it is equal to 31.1 grams. So this price what you see right now in dollars, this is the price of 31.1 grams. 1 ounce of gold is equal to $2,658. It moves a lot. Let's understand a bit about gold today. If you see there is the lowest and the highest today, there's a small L right here. Let me just try to zoom in for those who are not able to see this. Hope if this becomes visible. So I've just zoomed in the order ticket. If you see on the buying and the selling price, just below those prices, it says L and H. L stands for the lowest of the day. H stands for highest of the day. As you can see, lowest 2650, highest 2671. Gold has already moved $21, and US market has just opened uh, a few hours ago. And so see the movement, already $21 up. I'm going to go through the chart, the 2024, to show you that how gold prices have moved. um, why a lot of people buy gold using these online platforms? Because if you want to buy a bigger quantity and at the real time price, anybody who purchases gold, you know that the jewelers, they do not update the price every second. There are two time zones when they actually update the prices. So right now, if gold has gone up by $10, if you still go to a jeweler anywhere, they will not have updated their prices by up by $10. They have already said that price. You're buying at that price. Same goes for the downside also. If the price has already dropped or increased, the prices are not being updated. Here, you can actually buy or sell at the real time prices. So, in case if there's a sudden drop in the gold prices due to a news, you can enter into your online platform, mention the quantity, write the amount, and click on buy, and you will be able to actually enter into the transaction and buy gold without the need to be physically holding it. Which is my another point, that if you want to buy 100 ounce of gold, you can, and you don't really have to store it anywhere because it's already in your online account. because storing that much amount of gold would require an extra cost. So that is the reason why a lot of people they choose the online platforms to buy and hold, and sometimes just speculate also. Depends on what's the kind of investment style you're looking at. Now, right now the price of gold, as we know, it's around 2657, right? The lowest is 2650, highest is 2671. Let's go back and look at how gold looks on a chart and how it has moved in 2024. So I'm going to go here, I click on charts. Look at this. So guys, just for your understanding, the horizontal axis is the time, which right now right from here it's 2024, right? Starts from here. And then this is January, February, March, April, May, June, July, August, and then September as we speak. If you see uh, the trend of gold right now, look at this trend line right here, right? We'll zoom out a bit more to give you an idea. But look at this trend right now. Okay, so this is 2024 onwards right here. It started around a price of 2000, 2050, 2060. And after March, we have seen a significant jump in the gold prices. From 2050, it went to 2200. And then from 2200, it went next month in April, May to 2400. Took a drop again back to 2400. Again, took a drop again back around those levels. Took a drop and then finally crossed over and went higher. So look at the trends, how they move. Just going to show you a really interesting channel over here. Look at this range. And some actually, I would like to increase this a bit because sometimes, look at this. Now, this is where the gold price is. It peaked once, twice, again, the support and resistance. Now, see how on a technical chart, whenever there's a rise and then the falls does not complete this cycle. In fact, continues to become more and more, the fall continues to become smaller. It means it's trending upward now. It's about to break the channel. So if you see this here, 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 and then came halfway off, bounced back, again came way halfway off, bounced back, and they just broke the channel completely and went up. Obviously, you as an investor not really need to sit and draw these lines because you have your consultants with you and will help you out on this. That's what we do. But it's interesting to see that how commodities form these trends. And once there is a breakout, it continues to follow those trends. I'm going to take you back actually for gold. Would make a lot of sense if we were to go back a little more, somewhere around 2008 is when it all started. So you're looking at a very big trend right now. Look at this. So I'm going to form these channels to show you that how the trend in commodities could move. So this was between around 2007 to 2008 is when the recession bells ring. If we look at this small channel right here, 2008. And then look at this from 2009 when central banks started, um, it already slashed interest rates, started quantitative easing, injecting more cash in the economy, more dollars need to be printed until 2012. So look at this trend right now. Look at this channel, right? And then look at the break which happened. The moment it breaks, again a downward trend started between 2012 and 13 because the quantitative easing was stopped during that time. And if you see between 2013 and 2020, so we'll see two things. First, individual trend lines right here. Look at this. Look at this channel on the downside, and then it broke, it went up, right? Look at this channel right here, right? Look at this channel when it broke again on the downside and went for the next few weeks on the downside, and then again, right here. And then if you see this, a sideways trend, which is a great way to trade right here, right? And then again we see, so this is one. And then in between these ranges, because this I'm showing you years and years of data between 2019 to 2020, then 2020 to 2022, and then entire 2023, we see the big fall every single week, every single month, and then again bouncing back. And in between all this, if you see, a range was formed while you would trade in gold. Look at this right here. Look at this big channel, right? For from 2013 till 2020, gold continued to trade in smaller secondary trends, but a primary trend which had a support of 1020 or 1080 and a resistance of around 1400. And the moment it broke that resistance, it just went up and then continued to trade around that level. Commodities have a knack of moving in trends for a longer period of time. So that is why if you understand the trend well and be on the right side of the trend, it can really help you to get into the right trade. And you can enter into commodities by actually directly buying or selling that commodity, or there are a lot of commodity based funds, or we call it ETF, which are created by BlackRock, Vanguard, all these kind of companies. And you can buy these funds who already are holding the physical asset with them. So by investing in funds, you're indirectly investing into the commodity also. So these commodity based funds, even Bloomberg has a global commodity index fund which you can look into and invest into commodities. It's a diverse way of investing in commodities, because a commodity fund will not just have exposure in gold. They will have exposure in gold, oil, natural gas, silver, other kinds of instruments also, right? So this is where we are looking at gold. Gold as a commodity easily moves around $20 to $30 a day. So if you're buying 10 ounces of gold, goes up by 20 or $30, you might end up making $200 to $300. But then if it comes down by that much, you might lose that money also. So gold easily moves $20 to $30 a day. On an important day like a Fed event, it could easily move $50. And that is something which has we have seen this. I'm just going to close this chart and open it once again to show you a clear drawing of last um, let's say last 1 week. So this is from 18th after the Fed meeting, and look at this big fall right here, right? This is on the day of Fed meeting. Look at this big bounce right here. The moment press conference started on 18th of September, gold, which was at 2550, went all the way to 2600, and then came down from that really fast the next uh, hour and goes back to 2550. 50 $60 bounce and then again retracing back by 50 $60. This is the power of gold as a commodity. That is why there are so many people who do buying and selling gold every day. And look at the trend after that. It has gone back to that level. Today, it is even higher than what it was on the Fed meeting. To give you a broader perspective, since January or this, if you see 2024, gold is already up. Uh, Clearly, if you see, it is already up around uh, 30%. If you see, it was 2000 in the beginning of the year, it's 2658. It has moved up by $600, clearly 30% increase in just 9 months. If you see this month alone, gold has easily moved. Look at this month right here. Gold has easily moved up by 5%. It's already moving higher around 5%. So, the reason behind this, why gold moves up or down, um, many reasons: uncertainty, rate cuts, because rate cuts or reduction in interest rates pushes dollar down, bring gold prices up. Central banks are massively buying gold to protect their money value, and due to geopolitical reasons and wars and everything else, gold has become a primary choice of trading instrument or investing instrument, and that is why we have seen the prices skyrocketing since the beginning of 2024. So this is something which you can definitely look at, guys. I really want to introduce gold to you, and that is there. Similarly, next instrument, which is silver, has also shown phenomenal progress. And if you see silver, silver is priced $31.9 per ounce. It also has the same measure of unit. And if you see 2024, silver was $22 and it has seen a highest of $32. So since the beginning of the year 2024, and as you can see, silver was pretty much range bound for entire 2023. If you allow me to show you, in terms of, it had a very strong support around 2022.5 right here. And if it break this support, it would not be able to sustain more, and then it had a very strong resistance around 25. And look at this, it traded in a range for a long period of time. Like investors or traders would really love to buy silver and sell it around these levels. Look at these peaks and bottoms, right? Look at this peak right here. Yeah. So there are different zones of resistance. Let me put up one is here, right? And then if you see the support line, one more support line which could be somewhere here, right? So between this and this, look at this channel which has just formed. Look at the buyings over here, right? If I can make a, let's see if this works, right? Look at this, look at this, and then look at this peak, and this, and then this, and this, and look at this peak, bottom. Again, breaks the support, goes down, but again recovers back. Again here, bottom, peak, bottom, again, again, here, and then finally reaches here. It does not comes down, breaks this, and then forms another pattern. Right? Look at this. Right. So commodities, as I said, ladies and gentlemen, commodities, they trade in a range for a long period of time. And this is, we are looking at the chart which is since 2023. So somewhere the channel gets broken and then again a new trend starts. And silver follows gold most of the time, but there are times when gold and silver deviate a lot, because gold is a safe haven asset. When people are uncertain about where to invest in, or if they feel that there is something wrong, or they are very uncertain, or they are scared, they would buy gold, but they don't have the same sentiment for silver. Silver has more of an industrial application. So if there is something wrong with the manufacturing or trade wars, or something which can impact the value of trades and which decrease the supply or decrease the demand for silver, silver prices would drop. We have seen that in the past, when gold and silver prices sometimes deviate, but mostly because both of them are precious metals, they follow the same trend. Now, this was silver, then followed by platinum and palladium, who are priced in a similar manner, dollar per ounce. If you see platinum trend for a while, look at this. Again, platinum is not something which is like gold or safe haven, but if you see, platinum does have uh, a special feature when it comes. It can be used as an artificial jewelry. It can be used in a lot of other things. But if you see platinum since 2023. Look at this support and resistance right here. So line of support somewhere around here, right? And then again a resistance. Look at this. These are the peaks right here. Currently it's here. If it breaks, I think the next resistance should be somewhere around 1050 or here, right? A good point of buying 880, 890, and this is we are looking at somewhere around the trend which was 2023 onwards. If you see 2024, this is what it looks like right now, and it's currently here. So I think maybe the target is this, right? Or the target is over here, but good support level somewhere around if you want to buy, right? So this is platinum for you. Palladium is also a precious metal. It's used for a primary focus of palladium is on being used as pollution filters in your cars, and that's where the maximum usage of palladium comes in. Palladium is also traded a lot, but primarily you track the prices of all. Gold and silver are very, very important. And then there is copper, which is an industrial metal. Copper prices get affected by how it moves or how the manufacturing moves and what is the manufacturing condition in the economy. If the manufacturing in China slows down, copper prices get affected because the demand for copper is expected to decline in that manner. So if you see, look at 2022 when inflation was too high. Look at what happened to the copper prices right here, because 2022 was a time when China also suffered a lot because of the quarantine, and then the interest rates around the world increased. So see what happened to the copper prices from right here, from around 490, it went all the way down to 200, somewhere around 320, 330. And this is something which we have seen. And then look at the recovery once the markets reopen, and again the interest rate cuts off lately. In 2024 we have seen copper prices going from 300 all the way to 500 and above, and then again it has come to 446. So look at these bottoms, they are very clearly defined, right? There are a lot of these support levels which comes into the picture, and sometimes commodities, as I said, they follow a proper channel, they follow a proper trend. But commodities market moves, especially in copper, it moves if the manufacturing um, data comes positive or negative, and that is where most of the commodities they get impacted, right? And now coming to two important energy based commodities, Brent oil and WTI. Brent oil and West Texas, these are two kinds of oil which are traded. And the difference between Brent and WTI is where they come from and their composition. Brent comes from the Northern Sea, WTI comes from the US. In US, it comes from Texas, North Dakota, Louisiana. Now, also their sulfur content is different. One is sweeter than the other. And if you are thinking about Saudi oil, or oil which is basically from Aramco, Saudi oil is uh, not WTI, right? Or it's not even Brent. Mostly Saudi is, if you see Aramco, for example, it's a state owned oil company. So Saudi Aramco, it uses the Dubai or the Oman crude oil benchmark. So that's different. But if you see the Brent oil, that is mostly the Middle Eastern oil or the European oil, as we should say, because the Brent oil is extracted in the North Sea, which is near Europe. WTI, which is US, is extracted in the US. OPEC, on the other side, which is the Organization of Petroleum Exporting Countries, uh, does OPEC use Brent or WTI? Brent is a mix of crude from 15 different oil fields in the North Sea. That is why it is the benchmark which is used in Europe, and it is also mixed in with the OPEC reference basket. So, OPEC decisions which happen, it affects more Brent than WTI, right? If You ask which is better, Brent or WTI? Brent is considered the global benchmark because two-thirds of the world's oil is priced off Brent. WTI is, which is, it's the US benchmark for the pricing oil. So WTI, as I said, it's the benchmark for US, others is for European. Both are traded in the market. So if I take you through the prices of both, please remember this. I'm showing you Brent oil right now and I'm showing you WTI right now. Look at their percentage decline today. Brent and WTI both. WTI is down by 2.01%. Brent is down by 1.5%. But eventually both are down and both are very close to the percentage decline, right? So they both move in the similar direction most of the time. Uh, Brent and WTI, they are priced in dollar per barrel. So if you can see, $74, $71, this is dollar per barrel, right? One barrel is around 159 to 160 liters, but this is what they are priced. So whenever you are buying oil on virtual instruments, you will be definitely looking at the global prices, and that will be dollar per unit. Now, after this, oil normally moves uh, $1.5 to $2 in a day, up or down. If there is an important announcement or if there is a important meeting, something which is impacting the prices of oil or a Middle Eastern issue, that point oil could move $4 to $5. It's possible, but it's going to be a major, very major move. But otherwise, in a day, it moves. The range is around 1.5 or $2 is when the oil moves. So you can plan your quantities accordingly, right? There is natural gas. In agricultural commodities, we have wheat, coffee, and cotton. uh, how to look into agricultural commodities, that's also something really important, and I want to show this to you. Just let me share my screen with you and you will get that how normally a lot of people trade in agricultural commodities. I think this is something which a lot of us have missed out on because the popular commodities are always gold and oil, and it happens a lot of times that we kind of neglect more opportunities because they are less talked about. I'm going to show you something, and it's called seasonality analysis, and it's one of the best strategy to trade the agricultural commodities. Before we end the session, just let's go through the seasonality analysis and understand that how this would work. Okay. Right. I hope everybody can see the PDF which I've shared. Seasonality analysis is specifically meant for agricultural commodities. And why? Because these are agricultural commodities, so seasons they affect these commodities. And to give you a very good example over here, look at this. I'm going to talk about cotton. Cotton, positive December seasonality on cards. What does it mean? It means that December has been a positive month for cotton. We did an analysis which is called seasonality analysis where we see for how many years, and we see the month on month analysis, and we see that how which of the month has been more beneficial for these commodities. So you'll be surprised to know that cotton, out of last 20 years, out of 20 years, 16 times cotton has shown positive price in December, in the month of December. Now, there's a fundamental reason of this why. Cotton gained an average of 4% in August, maximum gain 23%, maximum loss 8.5%. So, not in August, in December. US, India, and China are responsible for producing over 65% of the world's cotton. So reduced output from these countries can lead to scarcity. So India, US, and China, they produce a lot of cotton. Now, if the output reduces from these countries, it can lead to increase in the prices. Cotton requires long frost-free periods, plenty of sunshine. It prefers warm and humid climates. December is the winter season in US. It is winter in India as well. Weather across the US is blowing dry to cold, stressing crops and harvest. And this is the reason why most of the time we have seen that supply impacts in the month of December and prices they slightly move higher. Now look at this analysis. You're looking at on the left side, you see the years from 2003 to 2023, and the months which you see are Jan, Feb, March, April till December. If you see a pattern, look at the end of December right here and see how in last 20 years cotton has shown negative pricing only 4 times, but most of the time it has been positive. It ends positive in December. Why? Because of the reason I just told you, that the supply of cotton reduces mostly in December because cotton is grown in humid weather, frost-free periods, and in winters, in especially in December, India, US, and China, all of these countries are colder, and that is the reason why we have seen a positive seasonality for cotton on this. So this is one way to trade in agricultural commodities, guys. Not a lot of people have seen this. Not a lot of people have been able to understand that you can actually trade in agricultural commodity using the seasonality, which is the very essence of agricultural product. Instead of course, there are a lot of other factors which influence, like if there is a import or export ban on a commodity, if there is a war situation, like for example in China when there was swine flu, pork as a commodity got affected. Recently the prices of eggs were soaring over. I mean, there are a lot of these uncertain events. But that being said, uh, if everything to be accepted or assumed normal, you would see seasonality taking into effect for a lot of these commodities. So I just showed you something for cotton. Let me show you something for raw sugar, which mostly is seen positive in the month of September. And if you see, on an average, 6% return has been observed in the month of September in last 20 years. Maximum return is 20.5, maximum loss is 14.7. Brazil is the world's largest producer of sugar in the world, followed by India. US is the biggest consumer of sugar in the world. Sugarcane requires strong sunshine and either heavy seasonal rainfall or plentiful supplies of water for the growth. So that is the reason why sugarcane is planted twice yearly in Brazil: in winter, which is August to September, and then in summers, which is Feb to April, in a very moist soil. Because it is mostly planted in August to September, so there is not much supply in the month of September. So if you see this, look at September. Most of the time in last 20 years, September returns have been positive, right? Rest, if you see all other years, have been mostly, there is no such pattern which we can find. But September, we find a lot of green, right? Because most of the time September has been positive for raw sugar. Again, guys, as I said, that there is absolutely no guarantee that this is how it is going to be. But that's what investments are, right? You do your own research, you find out a pattern and try to implement on that. There is always a risk of uncertainty, and that is why you diversify. But imagine diversifying into these kind of commodities. It brings so much diversity to your portfolio. It brings so much novelty to your portfolio, because a lot of times, even in commodities, you will be only aware about gold and oil, and there's nothing else. But here I am opening a different chapter for agricultural commodities to you, and how you can actually trade into commodities by using the seasonality card, right? This is for raw sugar. I'm going to share lastly something with you about rice. So rough rice in November, towards a positive side. Rice is among the top three consumed foods in the world, primary food for more than half of the world's population. 90% of the world rice is consumed in Asia Pacific, biggest consumer being China and India, and they're also the leading producers of rice. So there are two main strains of rice, as you can see here: Japonica and Indica. Each grows in different climatic regions. Indica is grown in tropical, subtropical regions such as India and southern China and Bangladesh. Japonica prefer the temperate regions in US and Spain. Rice grows well in hot and humid climates, abundance of rainfall. So November is known to be chilly month in US, India, and China. Weather is dry, not much rainfall. So the lot of stress on the output, and then again drought conditions due to climate change add to the stress on the rice harvest. So a lot of times the prices go up in November. So if you see November in last 20 years, 16 times or 17 times it has shown positive pricing, only 4 times negative. right? This kind of seasonality can help you to enter into the agricultural commodities market, and it brings diversification. That's my point. You can never be sure with one trade, you can never be sure with one asset class, you can never just invest in stocks or just in bonds or just in real estate or just in currencies or cryptos. You need to have diversity even in your portfolios, and that's really important. Why? Because trends change, commodities market move in different directions. So next thing which what I wanted to show you was, like, when we are looking at physical markets. Sorry. So here, Bank of America has said the bull is just starting, and commodities are a better bet than bonds for the rest of the 2020s, which is the coming next decade, which we are going to see in the next 10, 20 years. So they have predicted that commodities will outperform bonds until the end of the decade, and because there's been a rise in inflation, that did push commodities prices higher, oil and gold exactly, and then deglobalization, higher labor costs. They're reversing trends that kept inflation low over the past 20 years. Now, if you see, right now, there's a secular bull market in commodity which is just getting started, and that's really important, because um, we have always thought that, okay, this is the highest which it could go. But the point is that if you see gold, every new month there is a new high. So at this point of time, gold, if you see, it has particularly been a very strong force driving the solid performance of the commodities sector. The gold has surged, as I said, around more than 30% so far this year, 35% since inflation started to surge at the start of 2022. So if you see gold prices, again, they're at the forefront, and it is expected to even go more higher. If you see oil prices, they haven't held up very well relative to gold, but again, it's trading around $74 per barrel. About the same time, even in August 2021, it was about the same price. So it has not really reduced. But then there are a lot of these analysts which are predicting, because if you talk about US tariffs on Chinese EVs and steel to restore the semiconductors industry in America, these policies are mostly a headwind for falling prices, right? Um, Again, when we talk about uh, different kinds of policies which are going to come in elections, if Donald Trump comes, he's definitely going to promote for further rate cuts, and that could push gold prices higher. So there are a lot of ideas, and there are lot of commodities, and especially the popular ones. When we see oil and gold, they've always been considered more reliable for inflation hedge. This is one of the reasons why a lot of people they invest in commodities, because it's a very reliable inflation hedge. Investors demand more if inflation increases, right? Because inflation has been subdued over the past 20 years. The target is has always been 2%, right? But then again, if you see in last few months, inflation has tried to be under control. But if you see gold prices, oil prices, in last 2 years, it has moved much higher. Even in 2022, when inflation was going higher, we have seen gold prices being very consistent on the higher side. So this is what basically commodity markets are. I explained you how you can trade in seasonality using the agricultural commodities. When it comes to gold and silver, how much gold moves on an average, how it has moved along the last few years, what impacts the gold prices. Between crude oil, as I said, dollar per barrel, Brent and WTI, how oil moves in a day, $1.5 to $2, and you can easily buy and sell these products using the platforms, and that is something which is very easy to do a transaction. So just before we leave, let me show you how easy it is to execute a transaction on an online platform if you're using one. And let's say, for example, you want to buy gold, you just open the order ticket, select the quantity or the amount. So let's say, for example, if you want to buy gold worth just 10 ounces of gold, for example, which is worth $26,000, because these are margin trading platforms, you can actually buy gold worth 26,000 and only use just 1% as the token fee. So for example, this shows margin money. The margin is the money which you deposit to enter into a transaction and take the exposure. but the exposure which you will take will be of the original value, which is 26,574. But you don't have to deposit that much amount. You can just use 265 and take that exposure. Click on confirm, place your order, and it's executed real fast. Now, the catch is that whatever money you have given as the token money, the moment your loss reaches 50% of that amount, your trades are automatically closed by the broker. So you get a higher exposure, you pay a smaller amount, and the moment your loss reaches 50% of the amount which you have deposited, the broker closes your account. That allows you to diversify more. Obviously, trading on margin and taking leverage on your portfolio has its a very significant risk. So if you don't use it right, if you're not disciplined, if you keep your trades open, don't put a stop loss, day trading can lead to a lot of losses. That's why talk to your consultants, right? You don't need to have a certification in day trading. You need to have discipline in day trading. I have made you create a watch list. You need to check prices of these products. uh, Asia opens between 3 a.m., 4 a.m. in the morning. UK Europe opens 11 a.m. in the morning. US opens 5:30 p.m. in the evening. Each of these times, you can see the prices of these commodities, and you will see when the traders hit the floor, the prices of these commodities they move. A lot of economic data for Europe comes out around 1 p.m. A lot of US economic data comes around 4:30 p.m. And you will see during these special events how these commodities move. Once you get an idea of looking at the prices and tracking the prices day on day, day on day, day on day, it will start storing in your brain that if there is a change in that range, you will be able to pick quick that okay, now is the time to buy or sell, right? So once again, guys, thank you so much. I am available for a one-on-one session to discuss more about this. Obviously, these sessions are for 1 hour, so I want to make sure that whatever is relevant, I share it with you. But I am ready to sit with you more to speak more about leverage and margins and short selling and how you can take advantage of commodities in your portfolio. If you like the session, definitely reach us out on Google review Century Financial. Uh, Tell us, did you like the session, or if you have any feedbacks. I'm definitely, as I said, it motivates us to do more and more sessions. I'll see you tomorrow once again, 7 to 8 p.m. Tomorrow is going to be a very different topic, and so will be day after tomorrow. So attend all the sessions. That's all I can say. And if you need a one-on-one session with me, just talk to your relationship managers, and we'll do a session free of cost for you, just to make you understand that how these markets work, and just bring more awareness to your research and to your investment arena. That's the idea, to just bring more and more awareness. So thank you so much once again, and I'm glad that a lot of you have joined today, and I hope that I see you guys tomorrow as well, 7 to 8 p.m. Let's try to connect once again. And as I said, I'll be available for any one-on-one sessions if you need. So just go through this, take demo accounts from your RMs, and just create a watch list for yourself. And do talk to me. So I'll see you once again tomorrow, same time and on a different topic. Till then, you have a great night. Stay safe and trade with stop loss. That's something which I always would tell you.